The true battlefield of trading is not found in the chaotic movements of the market, nor in the complex algorithms of quantitative analysis, but within the mind of the trader themselves. While strategies, technical indicators, and fundamental analysis are undeniably crucial components of successful trading, their efficacy is profoundly diminished without a robust psychological foundation. As the renowned American psychologist Van Tharp astutely observed, psychological aspects constitute a staggering 60% of trading success, with money management accounting for 30% and strategy a mere 10%. This striking imbalance underscores a fundamental truth. Mastering the market begins with mastering oneself. No figure exemplifies this principle more profoundly than Jesse Livermore, the legendary speculator whose triumphs and tribulations irrevocably etched the importance of mental discipline into the annals of Wall Street. Livermore's career, spanning the volatile early 20th century, was a testament to the fact that the ultimate victory in trading is not against the market, but against the insidious forces of one's own emotions. The paramount mental battle every trader must win is the relentless struggle against emotional chaos. This internal turmoil manifests as a destructive interplay of primal human emotions, each capable of derailing even the most meticulously crafted trading plan. Fear, in its myriad forms, stands as a formidable adversary. It can appear as the paralyzing fear of loss, leading traders to prematurely close profitable positions, thereby limiting gains, or conversely to cling desperately to losing trades, hoping for an improbable reversal that often never materializes. This fear of loss fuels the common mistake of cutting flowers and watering weeds. Another iteration is the fear of missing out, or FOMO, which compels traders to jump into rapidly moving markets without proper analysis, chasing trends already well underway, only to find themselves entering at the peak just before a reversal. The fear of being wrong is equally debilitating, causing indecision, preventing traders from taking valid setups, or forcing them to abandon positions at the first sign of adversity, even if their initial analysis remains sound. These fears collectively lead to hesitation, regret, and a profound lack of conviction in one's own judgment. Conversely, greed, the insatiable desire for more, is an equally destructive force. It tempts traders to take on excessive risks, often by over-leveraging their accounts, driven by the seductive promise of rapid wealth accumulation. Greed encourages the dangerous practice of moving stop losses further away from the entry point, or even worse, removing them entirely, transforming a manageable loss into a catastrophic one. It manifests as the inability to take profits, holding on to winning positions for increasingly unrealistic targets, only to watch them retrace and turn into losses. This pursuit of the extra dollar often costs traders the dollars they have already secured. Beyond fear and greed, a host of other destructive emotions plague the trader. Anger, frequently a response to a series of losses, can lead to revenge trading, where the trader impulsively enters trades with larger position sizes, aiming to get back at the market, inevitably compounding their losses. Euphoria, after a string of successful trades, breeds overconfidence and a false sense of invincibility, leading to a neglect of risk management and a propensity to take on increasingly speculative ventures. Impatience, the antithesis of the calm, methodical approach, drives overtrading, forcing entries into suboptimal setups simply for the sake of being in the market, rather than waiting for high-probability opportunities. These emotional impulses collectively erode discipline, cloud judgment, and transform a strategic endeavor into a gambling spree. The manifestation of these emotions is evident in a litany of typical trading errors. Without a clear, defined trading plan, emotional impulses dictate decisions, leading to a haphazard, unsystematic approach. This lack of discipline results in erratic performance, making it impossible to learn from past mistakes or build a consistent track record. Impulse decisions made in the heat of the moment directly contradict any preconceived strategy, often leading to immediate regret and financial detriment. The blatant disregard for risk management, such as failing to set stop losses or moving them arbitrarily, is a direct consequence of fear, not wanting to realize a loss and greed hoping for a bigger profit. Furthermore, the herd instinct and the tendency to follow external advice, whether from social media gurus or financial news, rather than conducting independent analysis, is a deeply ingrained psychological flaw. It stems from a fear of being alone, a desire for validation, and a misplaced trust in others, overriding one's own rational assessment of the market. These common pitfalls are not merely technical errors. They are symptoms of a deeper psychological struggle, a battle for mental fortitude against the powerful currents of human emotion. Jesse Livermore, through his tumultuous career, distilled profound wisdom that serves as a powerful antidote to this emotional trading chaos. His principles, forged in the crucible of market speculation, offer a clear path to mental victory. Central to his philosophy was the unwavering commitment to discipline and a systematic approach. Livermore understood that a trading plan was not merely a guideline, but a sacred covenant with oneself. Its strict adherence, even in the face of tempting deviations, was the bedrock of his success. He emphasized reacting to the current market situation rather than attempting to predict its every move. This nuanced distinction liberated him from the emotional traps of conviction and ego, allowing him to adapt to reality rather than imposing his will upon it. A disciplined approach provides a framework that removes subjective emotional input, forcing objectivity and consistency. It transforms trading from a speculative gamble into a structured, repeatable process. Equally vital was patience. Livermore famously declared, "Money is made by sitting, not by trading." This seemingly simple adage encapsulates a profound psychological truth. The market rewards those who wait for the opportune moment, those who resist the urge to constantly be in action. Impatience leads to overtrading, forcing entries into suboptimal setups and chasing fleeting movements. Livermore's philosophy advocated for waiting for the market to confirm one's trading ideas, to present clear, undeniable signals before committing capital. This patient observation, rather than constant activity, conserves mental energy and capital, allowing the trader to deploy resources only when the probabilities are heavily in their favor. It is a defense against FOMO and the need for constant gratification. His insights into risk and capital management were equally revolutionary. Cut your losses quickly was not just a piece of advice, but a fundamental psychological imperative. Allowing losses to grow is a direct consequence of fear and hope. Fear of realizing a loss and hope for a turnaround. Livermore understood that small losses are a cost of doing business, while large losses are existential threats. Conversely, he championed the idea of letting profitable trades run, sitting on your profits, to capture the full extent of a trend. This requires immense psychological fortitude to resist the urge to take small, quick profits, which often stems from a fear of losing what has been gained. He also stressed controlling position sizes to maintain psychological comfort, enabling one to sleep at night. This means never risking so much on a single trade that its potential loss could cause undue emotional distress or financial ruin, preserving mental clarity for future decisions. Finally, Livermore underscored the critical importance of independence of judgment. He was a staunch advocate for trusting one's own analysis and ignoring the cacophony of external opinions, insider information, and market noise. Following the crowd often leads to being caught in the wrong direction, as the herd tends to be right only at the beginning of a trend and wrong at its turning points. Livermore knew that true success came from developing one's own understanding of market dynamics and having the conviction to act on it even when it went against prevailing sentiment. He understood that the market is never wrong, it is always the trader who is mistaken. This acceptance of personal responsibility, without blaming the market or external factors, is a cornerstone of mental resilience in trading. It fosters humility and a continuous learning mindset. These timeless principles of Jesse Livermore, born from decades of high-stakes speculation, offer a powerful framework for navigating the treacherous psychological landscape of the markets. They transform the abstract concept of mental fortitude into actionable guidelines. To truly grasp the depth of Livermore's insights and apply them to modern trading, one must delve into the primary source of his wisdom. For those seeking to transcend the emotional pitfalls and cultivate the disciplined mindset of a master speculator, a profound resource exists. The new edition of Reminiscences of a Stock Operator is more than just a historical account. It is a meticulously curated guide to the psychology and strategies that define Jesse Livermore's legendary career. This edition goes beyond the original narrative, offering insightful commentaries and expert analysis for each chapter, transforming Livermore's experiences into practical, actionable lessons for today's market participants. It bridges the gap between historical anecdote and contemporary application, providing a unique opportunity to internalize the very principles that allowed Livermore to dominate markets. By exploring the psychological underpinnings of his decisions, both successful and unsuccessful, readers gain an unparalleled perspective on the mental battles every trader faces. Discover how Livermore navigated fear, greed, and impatience, and learn to apply his timeless wisdom to your own trading journey. The link to learn more about this essential read is available in the description below. Building upon Livermore's wisdom, traders can adopt several practical tools to cultivate robust mental resilience. The formation of a clear trading plan is paramount. This plan must be a detailed blueprint, defining precise rules for entry, exit, and risk management for every single trade. It removes ambiguity and the need for on-the-spot, emotion-driven decisions. A well-defined plan acts as an anchor, grounding the trader in objective criteria and preventing impulse actions. It forces a systematic approach, which is the antithesis of emotional chaos. Maintaining a comprehensive trading journal is another indispensable tool. This is not merely a record of trades, but a systematic analysis of both profitable and losing positions. It requires documenting not only the technical details of the trade, entry, exit, size, profit, loss, but crucially, the emotional state, thought process, and rationale behind each decision. Over time, this journal reveals personal behavioral patterns, psychological triggers, and recurring mistakes, allowing the trader to identify and address their specific weaknesses. It fosters self-awareness and transforms failures into valuable learning experiences rather than sources of frustration. Effective risk management must be ingrained as a core habit. This involves the mandatory setting of stop losses for every trade, without exception, and defining the maximum allowable risk per trade and per total capital. These rules are non-negotiable safeguards against catastrophic losses and emotional overreaction. By predefining risk, traders detach themselves from the outcome of any single trade, understanding that loss is a part of the game, and managing them is key to long-term survival. This proactive approach to risk mitigates the fear of loss and prevents greed from leading to overexposure. Developing emotional intelligence is a continuous process. This involves practicing mindfulness, which allows traders to observe their emotions without immediately reacting to them. It cultivates the ability to perceive losses not as personal failures, but as integral components of the learning process. This reframing reduces the sting of setbacks and fosters a resilient mindset. Emotional intelligence enables traders to recognize when they are experiencing fear, greed, or anger, and to pause before acting impulsively, allowing for a more rational response. Studying behavioral biases is crucial for self-correction. Understanding common cognitive and emotional distortions, such as the anchoring effect, over-relying on the first piece of information, the gambler's fallacy, believing past events influence future independent probabilities, overconfidence, exaggerating one's ability, and the herd instinct, following the crowd, empowers traders to consciously avoid these pitfalls. Knowledge of these biases provides a critical lens through which to examine one's own decision-making process, fostering a more objective and rational approach. Utilizing tools for market sentiment assessment such as the Fear and Greed Index, can provide an objective counterpoint to personal emotions. While not direct trading signals, these tools offer a broader perspective on the overall market mood, helping traders to gauge when collective fear might present buying opportunities or when widespread greed might signal an impending correction. This external data can help mitigate personal FOMO or panic by providing a more detached analytical view of market psychology. Finally, regular breaks and maintaining life balance are essential for sustained mental performance. Trading is an intensely demanding profession, and continuous exposure to market volatility can lead to stress, fatigue, and emotional burnout. Regular breaks, time away from screens, and engaging in activities outside of trading help to clear the mind, reduce stress, and maintain perspective. A well-rested and balanced individual is far better equipped to handle the psychological rigors of trading than one who is constantly under pressure and emotionally drained. It ensures that trading remains a thoughtful endeavor rather than an obsessive pursuit. In conclusion, the mental battle in trading is not a singular event, but a continuous, evolving process of self-discovery and self-improvement. It demands unwavering vigilance against the destructive forces of emotion and a steadfast commitment to discipline and rationality. The enduring principles espoused by Jesse Livermore, though articulated a century ago, remain profoundly relevant today. His emphasis on discipline, patience, prudent risk management, and independent judgment serves as a timeless blueprint for navigating the complexities of financial markets. True and stable success in trading is not merely a function of superior strategy or access to exclusive information. It is ultimately achieved through the consistent application of emotional control, psychological resilience, and an unyielding dedication to one's own mental mastery. This journey is arduous, but the rewards of self-mastery extend far beyond the trading account, enriching every aspect of a trader's life. As we conclude our exploration of Jesse Livermore's enduring wisdom and the critical mental battles in trading, remember that continuous learning is the cornerstone of sustained success. To deepen your understanding of market dynamics, trading strategies, and the rich history of finance, we invite you to explore two invaluable resources. First, the Trading Insights channel offers a focused examination of the strategies, methods, and core principles employed by successful traders, speculators, and investors throughout history and in contemporary markets. It's an ideal companion for those who wish to dissect the practical approaches of figures like Livermore and others who have mastered the art of capital allocation. Second, for a broader historical context and a deeper appreciation of the forces that shape financial landscapes, the Wall Street Memoirs channel provides fascinating insights into historical events, pivotal financial crises, and the lives of other outstanding personalities who have left an indelible mark on Wall Street. Together, these channels offer a comprehensive perspective, combining practical trading wisdom with the essential historical narratives that inform today's markets. Subscribe to Trading Insights and Wall Street Memoirs to continue your educational journey. Links to both channels can be found in the description below.